Okay, good day everyone. My name is Daniel Chisom Joko. You can call me Daniel Woman. Okay, today we'll be focusing on introduction to cryptocurrency. But first of all, before we move into introduction to cryptocurrency, it is wise we know what blockchain technology is all about. Because the cryptocurrency we have been hearing about is built on blockchain technology. Okay, blockchain technology can be defined, or you can say that is a decentralized application that record the transactions of digital assets. Now, this cryptocurrency we have been hearing about is built on blockchain technology. It uses a technology called blockchain technology that helps in recording transactions, making it decentralized in the sense that no one has control over cryptocurrency because no one has control over blockchain technology. Now, one thing about cryptocurrency is that all transactions are public apart from that of privacy coins, because there are coins that are privacy coins. Those privacy coins, some of them you can't see their transactions unless you have a direct link to them. Like example, Bitcoin is a privacy coin, but in Bitcoin, you can search for the transaction if you have the transaction ID. But while searching for the transaction, you can't be able to track which wallet sent the payment or the coin due to as due to the coding in the Bitcoin core network. It is programmed in such a way that once you move out a transaction, the wallet address automatically change. That's why most of us that make use of blockchain wallet address, or some wallet companies, we find out that after a given transaction, our wallet address changes to a new one. That type of coin, we call that coin privacy coins. When there are, we call that type of coin privacy coins. Where there are some coins that are not basically privacy coins, just like the Ethereum we know, the Binance, the ADA, and other coins. Those coins, they are not privacy coins. They are built in a way that with one wallet address, you can be able to pull out all the whole transaction the owner have made. So, having defined what a blockchain technology is, what is this cryptocurrency we have been hearing about? Some say it's money, some say it's this, some say it's the other. But before defining what a cryptocurrency is all about, we need to know what money is. Because if you're able to know what money is, you'll be able to know if actually cryptocurrency is money or not. Now, what is money? Money is anything that is being generally accepted. That's the simple definition of money. Anything that a group of people, persons accept, and they add value to that is money. So money can be a piece of book. It can be gold, it can be silver, it can be metal, it can be crude oil, it can be anything. Once a group of people, a certain group of people have accept that item and add value to it, that's money. Now, what is cryptocurrency? Cryptocurrency is a digital asset, is decentralized, No one has control over it, and is generally accepted by a certain group of persons. And that's what makes cryptocurrency money. So this class is an introduction class. So basically I will pick things. I won't go into deeper definitions of them, because here basically what we want to introduce to you is how to trade cryptocurrency, how to input signals, how to receive signals, how Binance exchange and other exchanges work. So other for ban before we can get to that part, there are some terms that we need to define before we can get to that. As you can see on your screen here, these are lists of cryptocurrencies. There are over 10,000 of them. There are over 10,000 of them listed based on their market cap, their value, and their 24 hours traded volumes. So let's know what crypto trading is all about. Crypto trading is simply the buying and selling of digital currency using price movement. Now, the person that buy and sell digital currencies based on price movements are called crypto traders. And what does a crypto trader does? He analyzes the market, make sure he buy a certain coin at the very possible lower price to resell at a higher price. Now, in trading cryptocurrencies, there are different type of markets while trading cryptocurrencies. We have the one we call the spot market. As you can see, the one we call the spot market. The one we call the spot market. Here is the spot market. And here is another form of market. Another form of market. Here we call here the future market. I will take them one after the other. Then here we call this market the margin. We call this market the margin trading. A cryptocurrency trader that trades spot make use of spot market to input his trading after analyzing the market, to choose and select, to make choices of selections of coins that he or she want to trade. So what is spot trading? Spot trading is a method of buying and selling of digital assets at a current market rate, basically called the spot price. Now, in spot trading, you are physically purchasing the coin, whereas in the future market, you are predicting on the price movement of the coin. Now, what is future trading? You say that future trading is the prediction of price of a particular price of a coin based on what price movement. Now, in future trading, you are predicting that the price of maybe Bitcoin goes up, which is the one we call long, or or the price of Bitcoin goes down, the one we call short. So You know what happened in our normal predictions when we go to betting houses to predict on football matches. Once we stake a particular amount in betting, maybe like, let me say like 1,000 naira, and the betting goes to the opposite direction, you automatically lose your your money. So this same thing apply in future trading. Now, the next market we are to look at is the margin trading. Margin trading is a kind of spot trading, but in margin trading, you don't trade on your capital. You borrow capital to increase your trading capital. Like example, you have $100 and you want to trade with $500. You can use that your $100 to request for a trading loan as a collateral. You can use your trading capital as a collateral. Just here, as a collateral. You can use your trading capital as a collateral. In return, they will give you like 5 times of that your $100. They can give you like $500, while your trading capital will be used as collateral. So what happens there is that if you incur losses up to your collateral, automatically they liquidate your account. They will take the remaining $400, add it up to your collateral, and take the fund. So this is one thing about margin trading. And margin trading work with leverage. In margin trading work with leverage. Same as a future trading. So basically, we'll be focusing on spot trading for the purpose of the introduction class. So in spot trading, there are parameters we use in trading. This column here, we call this column the book order. What is a book order? A book order refers to the list of buy and sell orders of financial instruments, or maybe or of a digital currency, where they list pending orders for buying and selling of digital assets is what we call book order. Here at this column here, this is the part for sell order. When someone places a sell order of this particular digital currency, it goes here. It goes here. Wait as a pending order. It can wait as a pending order until the price reaches until the market price reaches that particular price the person inputs on his while trading. Why this other column here is for the buy order. When you make a pending order, maybe a buy limit order at a price maybe lower than the current market price. Here is the current market price. Here is the current market price. When you make, here is the current market price. Here now, this is the current market price. So when you make an order that is lower than the current market price, it goes here and wait as a pending order until the price reaches the current market price before your order will be triggered. So let's define some of the parameters used in trading. Here is the buy. Here is the buy. This buy is used in placing a buy order, while here is the sell, mainly used in placing the sell order. Other forms of other parameters are the market orders. We have this exchange currently have four types of market orders. One is the limit order, the market order, and the stop limit. While the fourth one is the OCO, which is one order cancel the order. What is limit order? Limit order is a type of order that purchase at a particular price. Now, in placing market, in placing position market based on limit order, the price is defined. You define the price. Maybe now currently the price of this coin is at 1.0712 dollars, and you want to buy this particular coin at 1.0500 dollars per coin. You set a limit order. When the market price reaches at this particular price, your order will be your position will be opened. The order will be triggered. Okay, let's take for example that I have this coin. Like example, I have this coin, and I want to sell this coin at a higher price than the current market price. But as you can see, the current market price is showing here. This is the current market price now. The best price you can buy from the market at this moment. And for example, I want to sell the ones that I have at a higher price using limit order. I have to select limit order. At what price do I want to at what price do I want to sell? I want to sell at the price of $1.1. And how many quantity do I want to sell? As you can see, I have 482 point some fractions. I want to sell 200 worth of it. 200 worth of it will give me $220. I will click on okay, I will click on I will click on okay, let me use a price that will be visible here. I will select this price. Now I will click on sell. As you can see, my trade is now pending here. My trade is now pending, showing pending limit order sell. This my order will be pending until the price keep going up until this current market price keep going up and reach at this price. My order will be triggered. So same thing. Then another type of market order is the market execution. In this type of market order, you buy at the current market price. You don't need to you can't define the price. The market based on this price. Now, depending on the quantity you want to buy. So at this price keep on changing. You keep on buying until you feed the quantity. Like example, say I want to sell 100% of what I have. Until maybe I want to sell 200 pieces of it until these 200 pieces of coin that I want to sell get filled up. It will keep on buying or selling depending on the command you are using. Either you are buying or you are selling. Why another form of market is order is the stop limit order. Stop limit order is a type of market order that has two type of okay is the type of market order is a type of market limit order when the market price hit the stop level. Now, in this stop limit order, you make use of two prices. You set up a range. You set up a range. This is the first price. This is the second price. You can say, okay, now that this price, the price of this coin is at 1.0639. You can say, okay, buy this particular coin from 1.0639 to 1.2. Now, what this thing simply means is that no matter what the market price, whether the price is going up or coming down, the market will keep on buying at this range. It can buy below this price, below this particular price, and it can buy above this particular price. It's a range. Let me say a range of from 1 to 2. You put in a range. When you say that you put in a range in particular something, you mean that don't go below 1 and don't go above 2. So that's what happened in this stop limit order. Giving a practical example of it, let me use this particular coin again. I have I have let me use the current market price. Okay, I want to sell at the rate of 556, and I want it to stop selling at 1.0656, and I want to use 25% of what I want to sell. Okay, let me say I want to sell 20 of it. Now I click on from here. Okay, from 60 to 61. Now click on sell network. I click on sell. My order have been pending. Let me show it to us so that you'll be able to see it. My order is pending. This is the price. This is the price I input, and this is the conditions. Conditions means buy from 1.066. Keep buying, sell, because this is a sell order. Sell from 1.066. Keep selling, and stop. Don't sell above this price. Once the price is above this price, keep my coin for me. Don't sell. That's how this stop limit order works. Another type of market order they have here is one order cancel the order. In this type of order, it makes use of two trading orders. One is limit order, one is stop limit order. Now, having defined what a limit order is, a type of market order that purchases at a particular price, you make the price here defined. The price here is defined. Now you put in a limit again here, then with a condition. This is just like a range from here to here. From this price to this price, like example, you can say, okay, you can say you can say buy this coin from here. Okay, sell this coin at this price at 1.0625, then stop selling at 1.0630. And here you can say sell this coin at 1.0625. What this order basically means is that, remember that here is a different type of market order, and this other one is another different type of market order. What this order simply means is that if this one triggered first before this one, they will automatically cancel this trade. But if this one triggered first before this one, they will automatically cancel this trade. But basically, this type of order is not that, it's only but few make use of this market order in trading cryptocurrency today. Now, another area I want us to look at is the price chart. Is a price is a price chart. What is a price chart? A price chart is just like a sequence. It's just like a sequence of price plotted over a time frame. It's a graphed representation of price movement based on time frame. Now, in, 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 in price chart, there are many things that we are going to be looking into, but because of this introduction class, there will be a kind of basic. In price chart, we have what we call time frame, and we also have what we know as price movement. You have the ones we know as indicators. So price chart is a graph representation of price movement. A price of coin move in patterns. So it shows you how the price move based on time frame. Like example, on this chart, I'm on 4-hour time frame. What this actually means is that this a candle here, all these lines, we call them candle. That one candle here represents the movement of this coin for 4 hours. Now here it takes, in this time frame, it takes 4 hours for a candlestick to complete its movement. Whereas in other time frame like 1 hour, here I'm loading the chart for 1 hour. It takes 1 hour to complete a candle movement. So counting like 2 candles represent 2 hours here. Whereas in 4-hour time frame, a candle represents 4 hours. Now it basically means that it took a complete 4 hours for this candle to start its price movement and ends here. It took complete 4 hours for the price movement to start for this candle to start its movement from the beginning here, and ends here, it took 4 hours. Why on the 1 hour time frame, it took 1 hour for this candle, no matter the size of the candle, have it, let her know that, note that it took 1 hour here, no matter the size, whether this one is longer, starting from here and ends here, no matter the height of the candle, it took 1 hour to complete that movement. Candlestick formation is a very large course topic on its own. It will be a topic that we handle some other time because there are many things to discuss about here. Here we can discuss about price movement, price movement. Here we can as well talk about support, resistance, and support level. Here is a support. Here is the resistance level. So price chart formation is a large topic on its own, and some other day we have to pick them one after the other. We discuss about this chart, everything you can see on this chart. Okay. In trading cryptocurrencies, currencies are traded in pairs. Like example, let me use this particular currency as an example. Okay. Let me look for another. Okay, let's use this currency for an example. Currency trading are traded in pair. This is what we mean by pair. Is either you are trading ATA against USDT, or you are trading ATA against BTC, or you are trading ATA against USD, or you are trading ATA against BUSD, or even you are trading ATA against the popular coin Ethereum. This is how we trade currencies. They are traded in pair. And why trading currency in pairs? We have the one we call the base currency and the one we refer as the quoted currency or the quote currency. Like example, ATA slash USDT. Here is the quote currency. Here is the base currency. What is the quote currency? We normally make use of the quote currency to take advantage of the base currency. A quote currency is the second currency in both a direct and indirect currency pair, and it is used to take advantage of what? The base currency. And basically, while trading cryptocurrency, we make use of stable coins. What are stable coins? Example of stable coins are USD, USDT, BUSD. There are some USDC. We as well have TUSD. These stable currencies, they are currencies that are pegged on the US dollar value. Their prices, their value are being determined by US dollar. They don't have value on their own. They are not independent just like other currency, just like this ATA, and they are not highly volatile in nature. Their prices goes up when USD, the American USD, goes up, and their value as well goes down when the American USD comes down. Now, in trading cryptocurrency, we make use of this USDT. We make use of these stable coins. These stable coins as the put currency and taking advantage of this base currency. Like example, let's assuming that we purchase ATA at the rate of when at the rate of $1.2 and we sold it at the rate of $1.5. Using what why making use of this put currency, which is this USD, we have taken advantage of the price movement of ATA. Now, basically, you can say that the put currency determine the value of the base currency. The quote currency determine the value of the base currency.